markets tend to lead economic outcomes. Now, the question to be asking is, has the market discounted the Fed enough? Now,
Right.
I would suggest that answer is no. I don't think a 20% decline after the advance that we saw in 2020, 2021 has gotten the market back in line with real economic growth, where we're going to be ex liquidity.
Welcome to Wealthion. I'm Wealthion founder Adam Taggart, welcoming you back for another weekly market recap at the end of the week, featuring my good friend Lance Roberts. Lance, how are you, buddy?
I'm glad to be back.
Both because of turbulent markets, but also I know you're packing your house up too.
Yeah, I know. Yeah, so yeah, went on vacation to Italy. Wonderful time. Had a great. We talked about it last week. Yeah, and then you come right back to the financial markets going all over the place, and then trying to pack and get moved. So it's been an interesting week.
Yeah. Hey, as they say, no vacation ever goes unpunished, right? So.
Exactly.
All right. Well, let's start with the weekly market action. Just looking at the markets from a high level here, they're up a bit this week at the end of the week from where they started, but not a ton. But it's additional strength, which you said last week you were going to be looking for. So give us a sense of what happened and what you're reading from it.
So a couple of things, on a real short-term basis, some bullish action, right? So despite all of kind of the negative media headlines and the world's coming to an end and blah, 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 the market's actually done some fairly bullish activity over the last couple of weeks. One, we've established some higher bottoms. So if you kind of look back to where we kind of pegged the recent lows of the markets about 3 weeks ago, since then, the market kind of based for about a week. We kind of didn't do a whole lot. And then we started kind of gradually easing up, but we started forming higher bottoms on the pullbacks. That was actually some pretty good news. And then from the March peak, if you draw a downtrend channel from the March peak to where we were, about 3 weeks ago, there's a very defined downtrend channel. And we have been really contained in that. Every rally that we've had since March has gone to the top of that downtrend channel, failed, and then went down and retested the bottom end of that channel, which means we were setting new lows. We actually not only tested the top end of that channel, we broke above it. And as we were talking about in our 3 minutes on markets and money, pretty much most of last week and this week, is that the challenge was going to be getting above the 50-day moving average. And that also occurred this week. So not only did we break out of this downtrend channel, that's bullish. We also broke above the 50-day moving average. That's bullish. And that actually kind of clears the way now. The next level of resistance is now going to be around 41.65, which is where we had a previous breakdown of bottoms and where the market's kind of started to gap lower. That was back in May. And then we have some bottoms that run back into February that run kind of along that same channel. So we've got some pretty tough resistance coming up here, but we do have a bit of a gap here now. On Friday, the market's kind of sold off here a bit, and that's actually good news as well. Markets were very overbought on a short-term basis. And we broke, like I said, we broke above that 50-day. So what we need to do now is to confirm that 50-day, which was previously resistance, and turn that into support, is test that 50-day moving average without going back below it. So this pullback today, we're starting to come back down. If we get a little bit more of a sell-off on Monday, test that 50-day moving average, don't break below it, and then the markets kind of bounce off that level. That could kind of pave that way for a little bit more of a move higher. So again, definitely not out of the woods, right? So we're definitely in a downtrend in the markets. That hasn't changed, but this is the first time, and you and I have been talking about for the last 2 months or so, that we were due for kind of this counter trend rally to kind of suck some of the bearishness out of the markets. I think we may be seeing that first kind of action of that happening. Enough bullish advance here to start getting people bullish about the markets, gets people less bearish, and that kind of clears that way for the market to kind of continue its process.
I want to build off that riff, but real quick, just a point of clarity. When you talk about the bulls want to see the 50-day moving average now switch from being a ceiling to being a floor, if the market breaks beneath it intraday, does that matter, or does it really just matter where it closes when you talk about support?
where it closes.
Where it
And,
closes.
and we're going to talk about in a minute. We're going to talk about some weekly data in a minute, and that's all about where it closes. So, what if you break below a support level intraday, and this is where a lot of people get really tripped up in trying to manage their portfolio. They go, I've had a lot of people tell me, like, I never use stop losses because every time I have a stop loss, I get, the stock breaks some moving average and I stop out and then the stock goes right back up again. Stop losses can do that for you, particularly in a market where you have so many algorithms that are hunting stock prices. They kind of hunt these stop loss levels. But this is why where you close is more important than the intraday breaks, because we see a lot of kind of end of the day buying by institutions. So you may break below a low during the middle of the day, but by the end of the day you've recovered back to it. And a good example of this was actually on Thursday. Markets gave up all their gains, went back to basically break even for the day, and then rallied to near its highs by the end of the day. So, you see these types of actions at the end of the day. So it's always better to wait for the end of the day, kind of see where you wind up, validate whether that support level held or not, and then make your decisions from there.
Okay. All right. Great clarification. I've got a question for you about stops, but before I ask it, should I ask you that first, or do you want to do the weekly?
No, you go ahead. No. The weekly's a bit bigger picture. We'll get there in a second. So
okay.
Go ahead.
All right. So, so stops, they should be a very prudent tool in, a prudent investor's arsenal here, right? Where they're a way for you to protect your, minimize your downside, but also protect gains if you're in a security that's gaining over time, right? There are different types of stops you can set. I won't get into all the details of them right now, but one of the criticisms that's lobbed at them, at least in the modern market, as you were alluding to, Lance, is some people will say, well, you're just guaranteeing you're going to sell your stock for, whatever stop you set. And the reason they say that is because in this highly algo-driven market, what tends to happen is the algos will do what's called crushing the bid stack or blowing out the stops, where they can see where the stops are set, and they will basically, over a very short period of time, I mean, sometimes in a matter of seconds, literally, will drop the price of a stock just to trigger those stops so that they can buy the stock at a lower price, clear out the stops in the bid stack, and then let the price float back up to where it was before. So it's kind of almost like an instant profit that these algos are able to generate here. Certainly sounds totally unfair. Whole other rant we could go on in terms of whether these things should be allowed to do it or not. But my question for you is just much more practical. Is there a way for prudent investors to use stops without kind of putting chum in the water for these algos, or is that just sort of a cost of doing business in today's markets?
Well, it's a great question, and we don't actually. So, and for that reason, and the reason that you just set out is exactly why in our shop we don't actually put stops on positions live, because if we do that, we're going to be talking about a stop on 50, 100,000 share blocks, and all of a sudden, those become very appetizing for, large institutions to what we call sub-penny the stock, bring that price down, trigger our stop, and then run the stock price right back up again.
Right. It's literally chum for the sharks in your case.
Yeah, and the bigger the bits, the bigger that chum is out there, the bigger the fish you're going to get, right? Yep. So what we do is, and again, it's just a function that you have to be very disciplined about what you're doing. But we have stop losses on every one of our portfolios. Now they're not put into the markets, but we've got them sitting there. We know where those stop losses are, and when those levels trigger us, and we have software that we have developed in our shop so that as soon as one of those stop losses are triggered, it alerts us, says, hey, this stop loss has been triggered on this stock. We immediately go look at it, we evaluate the stop position, look at what the price action is doing, and then we'll execute based on whether or not that stop loss seems to be valid or not. So, and again, what does that mean, right? One of the things that is also important about stop losses is that just because you trigger a stop doesn't mean necessarily you should act on it. Now you're going, well, what's the purpose of a stop loss then, right? What stop losses, tell you is where you break a level of resistance. Now, everybody in the market is watching the same levels of support on stocks, right? I mean, there's no secret ingredient out here. Every institution, every major money manager, most individual investors are watching the same levels on stocks, 50-day moving average, 200-day moving average, whatever it is. And so one thing that you need to allow to happen is sometimes you need to be able to break that stop. Don't execute on that stop. Just wait a minute, take a beat and see. Sometimes it's the next day, sometimes it's 2 days later, and the stock will rocket right back up. It'll break the 50-day moving average, and then a day or two later, the stock goes running right back up again. And that's because everybody was watching for that break of that 50-day moving average. And then they say, okay, so everybody sold. Now I'm going to buy it. And you start to see the price move up again. And this is why, we get, people talk about head fakes and other things. That's how this occurs. So one way that we manage risk in portfolios is we have these stop losses and we say, okay, if we break the 50-day moving average and we hold below that level of, no more than 1% below that level for a certain period of time, then we'll execute out of the stock. But we sometimes, if the market is very oversold, if the stock is very oversold, if there's been a lot of selling in the stock to get to this point, we want to give it a little bit of time to see if maybe there's some reflexive buying, just to, the market, the stock and the market kind of bounces. And when the market bounces, generally drags up about 80% of stocks with it. So generally you get a little bit of a reflex recovery, and then we'll sell it, right? But that way you can kind of manage a little bit better. So again, stop losses are very important to portfolio management, but there's also a little bit of art and, a little bit of the art to the science in terms of kind of understanding market dynamics and, evaluating, when you're extremely oversold and, and it's been a lot of pressure on the stock. And let's say you look at a stock and it's 3 standard deviations below its moving averages, stocks don't stay there very long. And so if that's where your stop loss is, you're going to be better off likely just kind of sitting and waiting, because you're likely going to get a bounce. Doesn't mean the stock's going to go back to new highs, but you're going to be able to execute out of that stock at a little bit better price than where it was right when you triggered that stop. So again, just a little bit of nuance to it.
All right. No, great explanation. And you're also giving yet another reason, one that I maybe wasn't even fully aware of why you want to be working with a professional financial advisor, which is they have solutions like this where you basically just described, you sort of have a private stop system, right? Where you're using stops, they get triggered, but it's not visible to the public markets, but you can act very quickly on them. So it basically forms the same function. It just doesn't put any blood in the water to attract those predators we were talking about.
Exactly. Yeah.
All right, great. Okay. So I'm going to ask a question that I think may lead into your weekly observations, but if not, why don't you force the connection? So we have started seeing some more companies begin to report, and we are seeing generally what we expected, right? Which is companies disappointing analysts with their earning forecasts, and then analysts then dropping their outlook for the companies. Snap is one that's just went through the meat grinder recently on this. I think it lost something like 20 or 30% of its market value after reporting the other day. So that's sort of in line of what we thought was going to be happening, which is an argument for lower prices ahead. But what's interesting, as you said earlier, the market's still shrugging off that news right now, right? The indices are finishing the week higher. And we are seeing some examples where the reverse is happening, where I'm going to use Netflix as an example for this, right? Netflix came out and they announced that they lost 1 million subscribers, which is bad news no matter how you slice it. But I think the market was anticipating that they were going to announce a loss of closer to 2 million subscribers. So it was less bad than the market was expecting, and clearly than the stock had priced in. So the stock's actually done quite well over the past week. And that has sort of been the wild card here, which is, had stock prices been beaten down far enough that even if the earnings forecasts are disappointing, they're not as disappointing as what the market was expecting. I think the jury's still out on what's going to happen here. And like I said, we're seeing some evidence on one side, some evidence on the other. So what are you taking from all this?
Well, no, remember, so last week we talked specifically about this. We said the one thing we're going to be looking for now, look, Netflix has a lot of other problems. So we were long Netflix for a long time. We sold it, very early this year. And, that was a good exit. And, I'm not really looking to jump back into Netflix anytime soon here. I think they have other longer term issues in terms of competition and a lot of other issues. Different story, different day. We can talk about individual stocks. But one thing I said, last week is that what we're looking for now is we're looking for companies that come out and kind of, poop the bed in terms of their earnings. And then the stock price either doesn't go down or actually goes up. And Netflix was a good example of that. And what that suggests is that a lot of that bad news is already priced in, and a lot of that beat down has already occurred. Amazon's one we're watching very closely. You don't need to be a hero here and try to buy the stock before earnings, right? Because you don't know what these companies are going to report. But Amazon's an interesting company that we're looking at because we think that all the bad news has been priced in. Estimates are pretty ridiculous on the stock right now. So once they report earnings, if they report bad earnings and negative guidance and the stock pops a little bit, we'll probably start adding a feeder position back into our portfolio because that's another company we own for a long time, and it's a major part of the index, and so goes Amazon, so goes the S&P eventually. So again, those are areas we want to kind of look at. And that brings up something else I want to talk, we'll talk about on the show today if we have a little time, is you don't have to be smarter than the passive indexers, and you can still be a good stock picker. But you can actually take advantage of the passive indexers as well on the stock picking side. Amazon's one of those cases where everybody's going to buy a passive index. Amazon makes up a big chunk of a lot of passive indexers. So as they buy the passive indexes, it drives your stock price up. So it's almost a self-fulfilling prophecy in a lot of ways. But as we kind of look forward here, look, earnings estimates are still too high, but they are coming down, and they're coming down sharply. Now, the difference between earnings growth, forward earnings growth being positive or having a positive growth rate, or forward earnings estimates having a negative growth rate going forward, is whether or not you're in a recession. So if we're going to be in a recession, then forward earnings estimates have a lot more to come down. And that suggests that we may have some more work to do valuation wise in the markets to accommodate for negative earnings growth. And look, there's a lot of arguments to be made right now for a more recessionary environment. Take a look at the recent ISM manufacturing surveys, a lot of the New York Fed, the Philly Fed, et cetera. New orders are plumbing into negative territory. Expected orders are very negative. I mean, you're just seeing a lot of deterioration on the manufacturing side. Economically, the question will be whether or not the service sector can hold up the economy. That's kind of a gamble here, considering inflation. But again, as we look forward, the question is going to be whether or not we've priced in these bad earnings. Now, as I said, and now I can kind of weave in this weekly stuff. If we actually step back from the market for a moment and look at the market, get out of the daily, up and downs of the markets and look at them on a weekly basis, there's actually some interesting things that are going on. The markets are extremely oversold on a weekly basis. And we're starting to see like the long-term MACD indicators, which is the moving average convergence divergence indicator. We don't need to get into all the mumbo jumbo. It's just how moving averages correlate with each other. But those are actually starting to turn positive. And that longer term MACD is a very good signal to actually add exposure to portfolios. Now, doesn't necessarily mean you're going to get a ripping bull market for the next 10 years, but you're talking about weekly data that suggests that you could see a fairly sustainable rally for the course of a month or two or three or four, right? I mean, you could see a bit broader intermediate term rally. Again, we're not there yet, but we're starting to see some early indications of maybe this market's trying to form a little bit of a bottom. It's very early, but as portfolio managers and as investors, what our job is to try to find value where it exists and take advantage of that. It doesn't necessarily mean the whole market is oversold. It doesn't necessarily mean the whole market is ready to start buying in just major indexes, but there's going to be some pockets of opportunity in certain stocks and companies and areas where we may have already done a lot of the work. No fan of Cathie Wood in the ARK investments, but if you dig into a lot of the ARK ETF, there's a lot of companies in there that are down 70, 80%, right? And you have to ask yourself, how much more downside is there to a company like, say, Palantir, right? I'm not saying go buy Palantir. I'm just pulling an example out. But that stock is back to where its IPO price was. how much more downside is there to it? Has all of the negativity and earnings growth kind of been wrung out of that stock? And has that been brought back down to a more reasonable level to where on a longer term basis, this may be an attractive entry point? And this is the one thing that as investors, we've got to kind of sort out a couple of different things. One, it's very easy to get wrapped up into the negative news headline of the day, right? I mean, look, economically, things are bad. The Fed's fighting inflation, they're raising interest rates, they're tightening monetary policy. I can give you a laundry list of reasons you should be sitting in cash and eating beanie weenies, right? It's just, there's plenty of that story out there. But looking beyond, look below the surface, and there's areas and pockets of opportunity that are starting to become very attractive investment wise. And this is where you start buying little nuggets of stuff that has the potential to grow longer term. Doesn't mean you go all in and buy 50% of your portfolio into Palantir. Again, not recommending that stock, just it was an example. So don't go jump off the cliff and go buy. Lance said buy Palantir. I'm not saying that at all. But you buy 0.5%, right? You buy a 1/3%. You buy just a little small few shares, and then if the stock drops some more and stabilizes, you add a little bit more to it. Once that stock starts to rally, and as we come out of this environment, and we will, the bear market will ultimately end someday, then you'll already have these kind of base positions that you've been building over time, and then you start aggressively adding into them as those prices start to increase and the environment and economy starts to match up with your thesis. But again, it's very easy to get all off on one side of the bearish camp and say, oh, I'm just going to be all in cash and gold and stuff like that, and then you miss the whole rally. We've talked about the risk of missing the rally before, and that can be just as bad as capturing the whole bear market. So part of this is just about trying to understand markets, how they work, look for opportunities, and navigate them accordingly.
Yeah, and this again is another reason to work with a professional financial advisor who has a methodology and a plan like this, which really tries to get all the emotion out, which is what you're saying here, Lance, right? I mean, you go back to sort of the famous Buffett quote of "Be fearful when others are greedy, and greedy when others are fearful," right? The only people who successfully buy at deep discounts are the ones that have done the research and have the conviction to say, hey, I actually think this is a good value now, and I'm going to make my decision based on that calculation, and I'm going to do it in a responsible way, meaning like I'm not just going to put all my chips on the table right now, right? It's hard for people to do that, right? Because when you're in a bear market, at least in America, we love to buy things that are going up. We don't like to buy things that are going down. So it's really hard for most people to commit capital when the price of something is in the gutter. And Lance, I think you've done a good job on the show addressing. We've had a lot of questions from people who are sitting in a lot of cash, and some of those people have been in cash for years. And one of the reasons why they have been in cash for years is because they went all cash, and then when things recovered, they recovered so quickly that the people said, well gosh, I don't know. The market's rallied now. I don't want to get all my cash back in if the rally is near the end here, and I'm going to come back in right at the wrong time. And so you sort of chase this market, right? You just, every time you look at it, you say, well, gosh, now the market's up even higher. So then maybe it's even more likely to correct. And so it's even harder to commit cash at this point. You just miss the entire rebound, right? So I think you've done a really good job for that. Okay, so one potential, some news caught my eye this week that just made me think, yeah, there are these other sort of just potential catalysts that could trigger more positive momentum here than we have right now. And the headline that caught my attention last night was, or maybe it was this morning, but looks like Russia and Ukraine have agreed upon a peaceful way for Ukraine to start shipping grain to the rest of the world, right? We've talked about how these disruptions of trade are going to disproportionately hit a lot of developing countries around the world, and one of the worst ways of that is reducing their food supplies. And Ukraine is a massive exporter of key agricultural commodities, notably wheat, to a number of poorer countries that without that wheat, there's literally going to be mass starvation in certain cases. So, if they're able to come to some cooperation and agreement on that, does that mean that that's a stepping stone towards perhaps some sort of peaceful resolution or at least ceasefire to what's going on in Ukraine? Who knows? We'll find out. But let's say it did, Lance. I mean, that's another trigger out there that could instantly cause these markets to catch a bid, right? If there was suddenly a truce announced in Ukraine.
Yeah, and actually, if you take, and it's interesting when you talk about this. So a couple of things too is that Russia just recently talked about they're going to start sending more oil and gas, to Europe as well. So we're starting to see some thawing of some of those tensions. Now it doesn't mean a resolution is near anytime soon, but I think what's interesting is that you talk about what's going on in Ukraine. It's like, oh, this is going to create starvation in some countries, and we've got this crimp in food supply, but yet if you look at agricultural commodities, they've actually been coming down in price, right? We're seeing commodities, actually coming down after this. We had this surge earlier in the year, and we've been talking about these inflationary pressures feeding through into the economy, but now we're starting to see gas prices come down, gasoline prices. We're seeing food prices come down. We're starting to see, just in the commodities, right? I'm not saying at the store, but commodity prices, we're starting to see a little bit of easing, right? So and here's the important thing. Markets tend to anticipate things, right? So, markets were already starting to tailor off some of the aggressive positioning in some of these commodities, knowing that, or anticipating that there was going to be at least some type of resolution. Look, the Russia-Ukraine thing is going to end at some point, right? It's going to be over. There's going to be a resolution, whatever it is. Ukraine becomes Russia, or there's a peaceful agreement to coexist, or whatever it is, but it'll eventually be over. And then that's going to be one of those kind of headwinds removed from the markets. And the question is have we priced a lot of that stuff in? Another one is the dollar strength, right? We talked about the dollar last week. The dollar kind of came off a little bit last week. That's helping give a bit of a bid to stocks as well. So, if we see a bigger correction in the dollar, that should also lead to a bit more of a positive bid for equities. Very quietly behind the scenes, we have an inverse head and shoulders forming in treasury bonds. Bonds had a nice little move up on Friday, very close to breaking that neckline support of this inverse head and shoulders, suggesting we're going to see higher bond prices, lower bond yields. And bonds have actually had a very good week this week in terms of relative performance. And that's also suggesting that we may be seeing, some early, I know it's early, right? But, maybe starting to see some of this disinflationary type of ideas starting to come through the markets. One of the things that, a lot of investors are also, and we've talked about this a bit, talked about this last week, is this, a lot of investors are just afraid of missing the bottom, right? They're just, they want to get into the markets because they're convinced that the Fed's going to pivot just any moment now, and they don't want to miss the bottom. So there's also that kind of underlying bid for stocks of just investors not wanting to miss the bottom.
So they're kind of front running the bottom, if you will.
Yeah, and it is, and a lot of it's passive. I mean, we got a lot of money flows going into passive ETFs. And as I was saying earlier, it's like you don't have to be smarter than the market. Just buy the top 5 holdings of every ETF, and that's where the money flow is going, right? Just follow the money. And if I buy an ETF with 50 stocks in it, and the top 5, stocks make up 20% of the ETF, just buy the top 5 stocks. You'll get the same performance as the ETF.
Yeah, it's worth maybe just repeating this again for folks that maybe didn't catch that the first time around when you were saying it. And it's funny, it kind of reminds me of that old joke about the 2 hikers that come across a bear, and one starts easing off his backpack, and his buddy says, "What are you doing? You're not going to outrun the bear." And he says, "I don't need to outrun the bear. Just need to outrun you," right? Where here, it's a little bit of the same thing, where you're basically saying, look, that those passive funds, once the market gives the all clear signal, the passive funds are going to have to start, redeploying whatever dry powder they have back into the market. And oftentimes they have to do that according to a preset formula, right? As you're saying, oh, it's these stocks and these are the 5 that we need to overweight and all that stuff. So you're saying, as a small investor, you can be more nimble and you can go, more quickly into the overweight stocks and then just ride the incoming tide of all that passive capital. Did I describe it correctly?
Yeah, no, that's absolutely right. Again, as investors, we don't have to be smarter than the market, right? We just have to be, like smarter than the other guy. So,
Yeah.
and again, to your point, when money flows come into the markets, a vast chunk of that is going to go into ETFs. We've just trained people over the last 12 years, just buy passive indexes and look, nobody's passive, right? Let's just throw out this whole idea of passive indexing because it's all crap anyway. If you buy an ETF and you sell an ETF, you're an active investor, right? You're not passive. You're just using a different vehicle, right? I can race motorcycles or I can race cars, but I'm still racing. And at the end of the day, it's who's faster across the finish line. It's the same thing in investing. I can trade individual stocks or I can trade ETFs and just buy a basket of stocks, for a move in the market, but I'm still active in those decisions. So if a lot of the money flow is going to come in, if the money's coming into ETFs, those ETFs all have to buy the underlying individual stocks. So let me give you a good example. You want to be a small cap investor. Look, there's a lot of, Adam and I have talked about all the risk in small caps. You got a ton of zombie companies. You've got all kinds of problems. Small cap companies are much more susceptible to weak economic growth than large cap companies. They don't have access to as much credit as large cap companies. So there's a lot of problems with small cap companies. So instead of trying to farm through and do all the fundamental analysis and try to find the one little small cap companies is going to be the next Amazon, just buy the top 5 stocks of the small cap index. And when the money flows come in, those top 5 stocks make up 10-15% of the small cap index. So when the small cap index goes up, those are the ones that are going to capture the most money flows, and they're going to go up relative to the market. So you can minimize some of your investment risk by just, again, kind of like being a surfer, just you trying to just catch the wave and just ride the wave with, some of those larger cap names. Look, we saw this for the last decade with FANG stocks, right? Everybody's like, oh, the top, the FANG stocks. Well, that's because those made up 20% of the S&P index. So every dollar that went into the S&P was going in to buy those top 10 FANG stocks. And that's why the markets, ran up so much.
All right. Well, look, great explanation. I want to turn a little bit now to talk about your partner and colleague there at RIA, Michael Leibowitz, because he was just, well, not at all. He was just on the Wealthion program. We gave him his own interview because when he very kindly stepped in for you the other week, he was doing that in the live Q&A and people really liked his answers, but he was sort of limited to the questions that were being answered. Yeah. Some of them were pretty granular. I wanted him to have the opportunity to kind of just share his overall macro view. So we had him on this week. Folks, if you didn't watch it, great interview. I'll put up a link to it right here. But it got, much kudos to you for picking such a great partner, Lance. It got a lot of great feedback. And Michael made a couple of larger points that I just want to bat around here with you. Sure. Love to get your reaction to them, and we'll just dive into it. So, in fairness to Michael, the points I'm about to go through are at a very high macro level. They're not like what's going to happen in the next week or two, right? But a couple, I thought they were interesting enough that you and I should chew on them for a bit here, Lance. The first one is that all things being equal, he sees lower prices ahead sort of throughout the rest of the year. I mean, he thinks that's the trajectory. It's that this, as we've been talking, the bear market is not over here. So even if we have some big violent rallies here, they're not uncommon in bear markets. But at the preponderance of data that he looks at, it just leads him to believe that there's a lot more excess that still has to be washed out of the system here. One of the things he talked about were CAPE ratios. And he made one comment, and this was not a prediction on his part, but he said, if you look at what it would take to get some of these things down into the territory of where they've sort of been to historical averages in certain cases, some of them argue for a 3-digit S&P. Right? Like that is the extent of the excess that could be wrung out of the system looking at that one data point alone, right? And again, he wasn't saying that the S&P is going below 1,000, but he's saying you can make in certain cases an empirical case that it could go that low. So first off, you're talking a lot right now about, hey, we have to trade the market that we have, and we may have a market that may go up for the next month or two or three, and may provide opportunities there for investors. And we, as a fiduciary, of their wealth, we're going to keep the big chunk of it safe, but we may see that this is a time to start with a risk reward trade-off starts actually getting attractive to us. That said, do you, and I know that, you and Michael don't have to agree about absolutely everything. I'm sure there's a lot of debate that goes on there, but do you still sort of share that sentiment that the bear market is probably not done here if we start seeing higher prices next week?
Yeah, no. So it's a great question. Yeah, one of the things that goes on in our shop a lot is that Mike and I and Nick and the other people on our portfolio management team, we go back and forth a lot and we debate a lot of issues. And one thing that we try to do with each other is take opposite sides of the same argument. Again, we talk about confirmation bias. So if Mike brings to the table when we're having our investment committee meeting and saying, okay, just to use an example, valuations say we've got to correct to 7 times earnings, and that's going to be another major bear market. My job is to counter that argument, saying, okay, but we also have these other issues. Because of what's happened with interest rates and monetary policy, valuations are no longer going to go back to 5 or 7 times earnings as we saw back, in the 70s and the 60s. We might be looking at a 12 to 15 times, valuation being the bottom for the market. And so we have these debates, and then what we try to do is then take those arguments and then try to manufacture a portfolio investment strategy around that. How do we navigate both of those environments? Because nobody knows. We don't know. Nobody knows. Mike doesn't know. I don't know. You don't know. We don't know where this market's going to be, not only next week, but 5 months from now. It's just an impossible guess. Too many things can happen. So it's important that we analyze these arguments and that we're aware of the data. It was interesting that comment about valuations got picked up by Business Insider, and they called Mike today and said, "So you're saying the market's going to decline another 50%, right? So beware, there's about to be a headline on Business Insider that says, stock market analyst says 50% decline and bear market coming," right? And that's going to be Michael's article that they write about him because they saw the Wealthion interview. So, this stuff gets, spun in headlines, gets kind of taken and kind of gets taken out of context. But Mike is right.
Sure. And they're going to do that if they can, because if it bleeds, it leads, right? So I apologize for any thrash I'm giving to Michael. I'm thrilled that Business Insider is watching our videos, but yeah.
No, but what I'm saying is that it's important to keep this stuff into context and understanding that just because, history says certain things need to happen doesn't mean they will happen. Doesn't mean they won't happen either. Not at all. And the markets could go down another 30, 40% from here. We need to be aware of that. And we need to be cognizant of that. Look, in this weekend's newsletter at our website, realinvestmentadvice.com, I'm going through looking at the markets relative to 1970, because this is the first time in the last 40 years that the Fed Reserve has been active in a stock market where the Fed is trying to quell double-digit inflation, right? We haven't seen that since the 1970s. So, I'm going back in charts and looking at MACD indicators and inflation and the stock market relative to where they were back in the 1970s to see if there's any correlation to what we could expect today. And what we find is that after the bear market of 1974, inflation was still going up, but so was the stock market, because valuations had corrected during that 74 bear market. We got down to 7 times earnings, dividend yields were 5%. Inflation was still going, and the Fed was active in trying to kill that inflationary impulse, but the markets had already front run that. The markets had already discounted those Fed actions. And so the market started rising into 1980, 81, 82, and then they corrected again. But it just doesn't mean that just because the Fed is active and the Fed is hiking rates and tightening policy, that markets have to decline, particularly if the market's done the work in advance. And markets tend to lead economic outcomes. Now, the question to be asking is, has the market discounted the Fed enough? Now, right. I would suggest that answer is no. I don't think a 20% decline after the advance that we saw in 2020, 2021 has gotten the market back in line with real economic growth, where we're going to be ex liquidity, because we're not going to have another round of modern monetary theory come pouring into the markets. And that's not going to happen anytime soon. So markets now have to start accounting for, and I don't think they've done this yet, start adjusting for a slower rate of economic growth, lower rates of inflation, and lower interest rates. And I think that's still coming. Doesn't mean we can't have a fairly nice rally in the meantime, but then another leg down wouldn't surprise me at all.
Okay, yeah, and that gets to the next point here, where I asked Michael, his sort of probability on us heading into recession, and I can't remember his exact answer, but my remembrance of the spirit of it was like, it's going to happen, right. Very high likelihood. I know you and I have been talking about that for a long time. I know there's an increasing chorus of people who say, hey, we're already in one, right? And we very well may be, but I don't think it's arrived at full force yet. I hate to say for folks, I can make a good argument that it's going to get a lot worse from here. But that's really where the economic contraction comes in, right? I mean, we've seen a contracting economy in the first 2 quarters of this year. I mean, the economy is in contraction as far as we can tell. But those were the easier times of the recession that we are either in or about to head in, I believe. And you and I have been talking about, the Fed may really end up getting the demand destruction that it wants. We've talked about layoff risks and the whole parade of horribles. So it sounds like Michael is as concerned as we that, tougher times lie ahead economically. And I just wanted to give you a chance to react to that in case somehow your thoughts have deviated from his at this point.
No, look, like I said, I agree with Mike. Look, there's a couple of things that still bothers me. The leading economic index declined by 0.8% in the most recent report. That took the 6-month rate of change in the leading economic index into negative territory. So we're negative 1.09%, and the 6-month rate of change in the LEI. The LEI index, that 6-month rate of change, is probably one of the best recessionary indicators on the planet. It's hardly ever wrong. And it suggests that a recession's coming. The thing that bothers me, and you and I have debated this before, is that everybody's predicting a recession. And, the old Bob Farrell line, when all experts agree, something else tends to happen. So what could keep us out of a recession? I don't know, right? But, employment is still fairly strong. We just, there's a lot of, issues with the employment data, but we're still adding jobs at the moment. So we can't completely discount that, right? Jobless claims are starting to rise up. We saw in the latest jobless claims reports, those are starting to ramp up here. Housing prices are coming down, lots of problems in the housing market. We're seeing that. So no matter kind of where you look across the board, there's a lot of evidence that says that this economy is slowing down rapidly. And I agree with Mike, I don't see how we avoid a recession at this point. It just kind of bothers me that everybody's, expecting one. However, now this is the interesting point about this. When everybody's expecting a recession, that's also getting priced into the market. So has the market already priced in the expectation for a slight recession, right? And that's a mild recession. That's because that's kind of what the media is all predicting, right? Oh, I'm just a little mild downturn, no big thing. What they haven't priced in is a more real recession. And I think that's the real risk here, because again, the whole run up we had in the market was all artificial liquidity, $5 trillion of, stimulus checks, et cetera. And the Fed doing 120 billion a month in QE. That's all gone now, right? The Fed's taking liquidity out of the market. And I think that when you look at valuations and liquidity, those are the two big drivers of the markets long term. And right now we've got high valuations and contracting liquidity. So that doesn't really seem to be a strong, mix for a surging bull market. Now, it doesn't mean, again, I just want to go back to the fact that it doesn't mean we can't have a fairly strong counter trend bull market rally here that sucks a lot of these bears back into the bullish camp. I would actually love to see that, because that actually gives us a lot better ability to short the market, reduce risk, et cetera, if we are going to have another leg down. So, there's, I think the two things that we really got to pay attention to, and the one thing the market's trying to figure out is the Fed going to back off of their aggressive stance? Right now, we're going to see a 75 basis point rate hike next week. That's pretty much priced in. But has the market priced in 75 basis points in September, 75 basis points in November? Or is the Fed going to back off of that and start talking about, well, maybe we need to wait and see approach to this? And if they do that, does the market begin to expect that, oh, now they're going to go back to maybe lowering interest rates, restarting QE, stopping the tightening? That's what the whole market's looking for, right? The whole market has been so driven and trained by the Federal Reserve over the last 12 years of just if the Fed pivots, got to buy the market. Everybody's looking just for that change.
Well, and so that goes to my next point here, which was Mike and I also talked about the topic you and I have talked about, I think, a lot last week, which was, when everybody expects something, oftentimes something else happens, right? Yeah. And so people might get the Fed pivot, but it might not have the impact on assets that they expect it will, right? And I think a lot of people are thinking right now, okay, Fed pivots, we just go back to the world that we lived in for the past decade, where I raised Bill Fleckenstein's prediction that if the Fed does pivot, that's actually when it loses the bond market. Unless inflation is tamed, which it's highly not likely to be if the Fed pivots within this year, that's when the bond market gives up on the Fed and starts driving yields higher, even though the Fed's trying to bring the short end of the curve lower, right? And Michael seems to think, yes, and Michael, worked for Fannie Mae. He understands the bond market really well. That's, I think, his primary assumption from what I got from him. Yep. And so, the question that I kind of want to ask you here is, you're a capital manager, and you're trying to do what the viewers are doing as individual investors, but this has got to be such a crazy, hard, challenging time to manage capital, because we just went through a number of bullets there where you're like, okay, yeah, I think there's a chance that markets may actually rally, fairly hard here in the short term, and I want to be able to capture some of that. But then if the bear market then resumes, I don't want to be caught, flat-footed and get crushed when the bear market comes. And then it may actually bottom like it did in the mid 70s, and the stock market might start going up. But if we go into a worsening recession, that might counter that. And then, Jesus, if the Fed pivots and we have this, there are so many crazy factors, so many cross currents there. It's got to be really hard to come up with sort of a unified, okay, well, if this happens, we're going to do this, right? You have to have like an alphabet soup of different plans, it seems like. So how do you tackle this as a capital manager?
Well, you just gave me the idea for the title for my next article, which is called The Mousetrap Market, right? So, there's the cheese in the mousetrap. And if you're trying to get the cheese out of the mousetrap, the question is whether or not you get your fingers snapped in it or not. You're absolutely right. This is the challenge that we face right now. We're sitting on, a lot of cash in our portfolios. We're underweight our bond portfolio. We're underweight equities, and we're going, okay, look, if markets really start to rally, we've got a fairly large lead over our benchmark index right now. That's great. But because we're so underweight bonds and stocks and overweight cash, if this market really does take off in a rally, we're going to give up that lead pretty quickly. So the issue is do we try to put some money to work, and do we try to capture as much of this rally as we can, or do we sit back and wait? And if you sit back and wait, to your point, this market could, maybe the market bottom is in, and then all of a sudden in 3 months from now, we're starting to approach, all-time highs, and we're trying to figure out, what the hell did the market just do? Because none of this makes any sense. And this is the real challenge to the market. And unfortunately, there's not a yes or no answer. This is a function of where Mike and I and Nick and everybody else in our portfolio management team is sitting around going, okay, we're going to make these investments. We're going to, start trying to add into positions over here. We're going to extract from positions over here. We're going to keep this risk control within the portfolio, regardless of what the market does. It won't hurt us as much as it could. So, and this is kind of like sailing a ship. You're just going to have to navigate what comes. And the problem with trying to predict, and this is always the big challenge, is, look, you've got two ways to manage this. I was reading an article today. A guy wrote an article. He said, basically, look, markets go up and down, just buy indexes and hold them, and you'll be fine over time. And it's too much work to try to predict what markets are going to do. Just sit there and let it all wash over you. That sounds great in theory, but the reason he's writing that article is because he's getting slammed with phone calls right now going, dude, we're just losing money left and right. What are you doing? Right? What am I paying you for to sit here and just ETFs and watch my capital float away? but that's one way to manage it. You can certainly do that. The other side is you take a more aggressive, it's not aggressive, but a more active approach to this and try to sail within the waters that you're in. And right now we're kind of in the middle of some very rough waters. And on one side, we've got a bunch of, rocky shore that we got to be careful not to run up onto the rocks. On the other side, we've got the open ocean. And the question is, how do we get to where we want to, over time? And that's just going to be a function of trimming cells and navigating and paying attention to what's going on as we kind of go through this. And it's not an easy answer. And again, I wish I could just tell you, this is what's going to happen in 3 months. The market's going to be lower than they are today, just sit in cash. And in 3 months, start buying everything you can find. Right. That may be what turns out. Mark that, because if that turns out, I want to be able to say I said that. But, I have no idea, if that's going to be the case. In 3 months from now, we could be substantially higher than we are now. 3 months from now, we could be lower. And the question is how are you going to navigate that, and how are you going to manage your money in the process of that?
Okay. Yeah. Well, great explanation. And
no, that was a terrible explanation because there is no answer.
No. But you talked about how you will tackle it, right? Yeah. Given all the unknowns. And I'm just going to re-underscore a message I've already made several times this video. The average person, does not have the market expertise that you do to navigate all that turbulence, but they also just don't have the time, right? I mean, you and your team, it's a bunch of people, spend your whole days, analyzing and reacting and recalculating and all that. And most people, they've got real lives, they've got a lot of other demands on their attention. So folks, again, I'm just playing my same old saw, which is work with a good professional financial advisor if you don't already have one, unless you're a super experienced investor. But I got to say, just law of averages here, it's a small percentage of you who are, and I don't even put myself in that category here. That we're in such a highly unprecedented, unpredictable, volatile, time in the markets where you're going to want professional help in figuring out how to navigate this. All right. That being said, I got to start wrapping up here, Lance, but I got a couple of things I want to talk through with you before we actually hop off. I got a rant, and we'll get to that in just a second. Just real quick idea, and I'm going to hope I can explain this succinctly. I just tried to do it beforehand, and I totally failed. But I put a video out recently on I-bonds, series I-bonds issued by the U.S. Treasury. Folks, if you haven't seen the explainer video I put on it, you can watch it here. That'd be a good one to watch after this if you haven't seen it already. And these are instruments that make sense to own, or the appeal of owning them increases in times of high inflation, because they inflation adjust. And what's attractive about an I-bond is it gives you guaranteed loss protection to reported inflation. You're going to get your principal back, and when you sell the bond back to the Treasury, and it's going to accrue interest on your behalf over the time you hold it. And that interest is based upon the CPI. So it's the CPI goes up, the interest rate it pays adjusts for that. So in theory, you don't lose purchasing power to inflation. And right now they're returning, I think the rate on the current I-bond is 9.62%. Mm-hmm. So they're actually right now yielding above what the current reported CPI is. The biggest downside with I-bonds is that you can only buy $10,000 worth in a calendar year per person, right? So one thing I just want to let people realize is, so a number of people say, okay, well, look, I'll buy it, but I obviously can't shelter. If you've got a lot of assets, you can only shelter 10,000 in a given year, and that might not work for people who have a substantial amount of assets. What's interesting, though, is if you have a family, you can have everybody in the family buy an I-bond, right? So let's assume a family of 4. You can all buy I-bonds, and that's $40,000 that you can shield this way. Okay, so we've just quadrupled the amount of money that we're shaving in there. I won't get into this too much, but if you're due a tax refund, you can actually get an additional 5,000 I-bonds through that. So you can get a little bit more, get maybe a little closer to 50,000 per household. But then there's this concept of you can gift them to one another. So if I have a spouse, Lance, I can gift her I can give my wife 10,000. Now she can't take delivery of that this year if she's already bought I bonds herself because of the 10,000 limit. So what happens is that I bond gets put in what's called a gift box, and it sits there until a year such that she's not putting any money in herself, and then she can take delivery of the I bond that I bought her today from that gift box. Now the important thing is it's been earning interest since the day I granted it to her. So where I'm going with this is, let's assume that you think that over the next year and a half, CPI is going to be high, but it's eventually going to trickle back down to where it's been more historically. So you could say, all right, look, I either want to buy a 1-year T-bond, right? And I can get paid 3%. And then in a year, I'll get my principal back, right? And I'll have made 3% off of it. And you can certainly do that. But what you could do as this hypothetical family of 4 is you could all buy T-bonds in now, and then come January 1st next year, and then at the same time, you could grant each other $10,000 worth of T-bonds too, right? So you've now doubled the T-bonds you're all getting that are earning today's high 9.6 rate. Right. And assuming that it takes a while for rates to come down, you can all also buy T-bonds again yourself January 1st of next year. So January 1st of 2023. So that's another 40,000. Another 40,000 for your family. So we've taken 40,000 you bought in 2022. You've gifted another 40,000 to each other. You've then bought an additional 40,000 on January 1st of 2023. Now we fast forward to January of 2024. Maybe rates have come down and you say, okay, I want to sell all these bonds. Well, you can, because you can take delivery in that year of the bonds you gifted yourself this year. And since you have to hold I bonds for a year before you can sell them, but that'll be more than a year from when they were gifted to you. So at that point in time, your family of 4 can sell all 3 subsequent tranches of the I bonds you bought this year, the I bonds you bought next year, and the I bonds you gifted to each other this year. So that's $120,000 that are earning maybe 3 times what a T bond is or T bill is, 1 year. Sorry, T bill, I guess, note is offering right now. So I probably murdered that. I hope people could follow along, but Lance, I think you followed. Does that make sense? It kind of almost gives you the same amount of protection of that 1-year T-bill, but you're making potentially a lot more yield off of it.
Well, true. I think you've put way too much work into this.
I know. Sorry. Maybe we'll cut this section. Who knows?
No. It's fine. It's fine. First of all, if you don't have any kids, go adopt some real quick, and they're more expensive than the I bonds. But other than that, it's look. There's a lot of ways you can skin that cat, and the one thing the one thing about I bonds to remember is that when you buy an I bond, when you cash it in, your rate of return is 0, right? Because it's just inflation adjusting your savings. So
your real rate of return is 0.
Your real rate of return is 0. So it sounds great on the surface. It's like, great, I got this 9.5%, whatever. But that's going to come down. If inflation falls sharply, it's going to come down quickly. So just make sure you understand why you're buying I bonds.
Right. But no, just to your point. So you're right. But by definition, with an I bond, your real rate of return is 0. The problem today is it's very hard to find assets that have a superior rate of return right now. They're all giving you negative real returns right now.
Exactly. And so what I bonds are great for is college savings. If you've got kids that you want to provide college savings for at some point, we talked about not robbing your own retirement, buy I bonds and let them sit there. And that purchasing power of that dollar will be there whenever they get ready to go to college. So your example is great. And if you want to go to all that kind of
trouble,
the work to do it, I think it's fantastic. I hadn't thought about it that way.
All right, great. Well, I didn't want to create a whole new video on it. So at least thanks for giving me the opportunity to give folks that addendum.
That was great. Here. It's great.
Yeah. All right. Well, look, let's quickly get to the rant here, which is I just sent a tweet out around this morning that seems to have gotten some traction. And it's about Blackstone's. It's a massive hedge fund that is basically putting $50 billion in reserve because it expects that indeed there's going to be a pretty material correction in the real estate market. And boy, it can't wait to step in and start buying, residential homes at lower prices with this $50 billion war chest. Right. And so I think we've talked a little bit about this in the
Which
past.
Which they did, by the way, they did that after the 2008 financial crisis too.
Yeah. So, and that's something that's relatively new, right, in the residential housing market, is that institutions have gotten way more involved. There's always been, the mom and pop landlord out there, but in the past, decade, we've seen a massive increase in big institutional money flowing into the residential housing market, and not multiple units necessarily, though they're heavily in there, but they're now in the single family home market as well. So they're out there competing with regular people who want to buy a home, but they don't have the deep pockets that these institutional guys get. And more importantly, they can't borrow at the same amazingly low rates that these guys get. We have to pay a much higher cost of capital. So it's not a fair competition at all. And we don't need to get so much into it too, but there's also this factor that these these companies, these corporations, they're eternal, right? Meaning like a human being has a limited life, and most property that a regular person owns, there's a forcing function that generally happens when the homeowner dies, where the estate gets split up and the house has to get sold or dispossessed in some way, where a corporation doesn't have to go through that because it's eternal. It can just always keep building its empire over time, and it can benefit from infinite the infinite benefits of the law of compounding, right? So it can eventually own a whole neighborhood, and then a whole town, and then a whole, and so my general point here is, is it too much to ask our government to note this problem now and try to strangle this, still adolescent monster before we end up waking up one day and finding that we're just a nation of renters to our corporate landlords?
But this is, it's interesting you bring that up, because this is the whole great reset theory, right? Which is that eventually you'll own nothing and you'll be happy about it, right? And the government overlords will own everything, and you'll basically just rent everything you want from them. You'll rent your house, your car, your TV, everything. You'll just rent it, and you're going to be completely happy with that. And that's the whole push, right? This is the whole push of, this whole push against capitalism. Why, 40% of, Gen Zers are favoring socialism over capitalism. They just free money, right? We all love the MMT thing, right? We all wanted, free. We want free college. We want free healthcare. We want free. That's great. The thing about free is it's not free. It's just free in a different form of what you're paying for. And it just means that somebody else owns all the assets and you're just going to rent it from them. But yeah, it seems free, but it's really not. And, your wealth equality is going to go down. Your economic prosperity is going to decline to the lowest common denominator. And, we talked, Adam, I talked about last week, Italy is eye-opening. When you go to Italy and you look around at what the vast majority of Italians and where they live and how they live, you can see kind of what those consequences are in action, right? And the wealth disparity. So we talk about the fact, like, top 10% of income earners own 90% of the stock market. The top 20% of income earners own, a vast majority of the net worth of the country. You're in the bottom 50%, you're barely getting by. We've all talked about these stories. And, here's the interesting thing about this. You're right. These big hedge funds, et cetera, they're going in and they don't buy a house, they buy a whole neighborhood of houses, right? And they do it all at one time. You hear about these bidding wars on houses, and look, Blackstone doesn't really care if they overpay for a house by 10% or 15% or whatever. They have no intention of ever selling the house. So they'll just buy it. Doesn't matter what they pay for it. They'll get their little guys out there to go bid for the house. Then they'll overbid for the house. They'll get it. They're going to lock this thing up and just rent it out for the next 150 years or however long the house exists. So they pool up all these investors, and they all guarantee these investors, some rate of return. Hey, invest in our fund. We've got this fund put together. It's a real estate investment fund. Put your money into this, and we're going to guarantee you a 7% rate of return over some period of time. And they're going to collect a bunch of fees on it, and they're going to take a percentage of the ownership. And, so they're not even borrowing the money from the bank. They don't have loan requirements, right? They're just getting money invested into their funds that they're turning around and investing into, buying these real estate properties. Here's the problem though. Let's go down that slope you just went to, and let's go to the government and say, the government needs to restrict corporations from investing into housing. Okay, we can do that. But now you're impinging upon free market capitalism. There's nothing that says that a person that's bidding on a house can't be an entity that's bidding on a house, right? And so once you start going down that slippery slope of saying who can and who can't compete within the capitalistic market, now you start opening up more and more regulation for, well, you can't compete into the housing market because you have more than $1 million of net worth. We should only let people with, $50,000 in net worth, bid into the housing market, whatever it is. I mean, I'm making ridiculous examples, but you get my point.
Yep.
Is that once you open up that Pandora's box, that's the danger. It's not fair. It's not, look, I agree with you. What's going on in housing is not fair, and it's forcing a lot of people into inaffordability. But this is what I said, there was an interesting chart, and I did a whole rant on my radio show earlier this week about down payment on houses. We wouldn't have this problem if we hadn't started messing around with mortgages and everything else back in 2000 and doing adjustable rate mortgages and no income loan mortgages,
right.
et cetera.
3% down. And
yeah. There was an interesting chart in Bloomberg, and it says, it is now taking the average person 10 years to save up a 20% down payment on a house. Now, the way they quote this thing, it makes it sound like that's a terrible thing, right? That's terrible. It shouldn't take somebody 10 years to save up on a down payment for a house. It took my parents 15 years to save up for a down payment on their first house, right? And back in the day, you had to have a bank would not even talk to you about a loan unless you could pony up 20%
unless
for
you had
down
at least
payment.
20, yeah, exactly.
Yeah, and that was because you had skin in the game. And so when you showed up at the bank and said, hey, I'm going to put down 20% on this house, the bank says, okay, great. I'll loan you the other 80 because you got skin into the game. You're not going to tear up the house. You're not going to turn it into a slum or whatever, because you've got a big chunk of money in the house. So it kept, what this did was it slowed down the rate of people being able to buy a house, which kept home prices, stable. And in fact, home prices just kind of rose with inflation over time. So you had 3% inflation, and house prices rose about 3% annually, exactly what they should do, because it's real estate, right? It's not an investment, it's real estate. And it should grow at the rate of inflation, not 20% a year like we're seeing now. But beginning in 2000, we started doing, we said, well, everybody should own a home. No, everybody should not own a home. People that can't afford a house should not buy a house. But you created all this demand, which ran up home prices, and that attracted all this corporate money back into the market. So now, to your point, let's fix the housing market. How do you get institutions out of the housing market? You bring the rate of return down to where it's no longer attractive for their investment pools. How do you do that? Require a 20% down payment for every house, and that eliminates all this excess buying. Rates of return on houses are going to fall back to 3%. That's no longer attractive for institutions like BlackRock. They're going to sell all their houses into the markets, giving us plenty of inventory to buy, driving house prices down, allowing people that have no money to now afford a house. I fixed it.
No, so look, that would be great. And that may be the solution, which would be wonderful. I mean, I hate to have the words come out of my mouth of, hey, we need to get the government involved, because I'm very much the government that governs best is the one that governs least and all that stuff. But, we do not have a free market in the housing market right now for the reasons I mentioned. There are unfair advantages these large players have that the rest of us don't, right? I like that solution, Lance, not to think about it more to see if it really be in totality a good solution, but it's simple, it's elegant. And one thing people forget is before really, the late 90s, the annual appreciation for housing in the US pretty much matched the rate of inflation, right? A house was not it was not a speculative asset. It was not something you bought expecting, oh, I'm gonna have this magnificent appreciation in my house. It was really more of a forced saving vehicle, right? It was just, hey, by the time I paid this thing off, I won't have rent or mortgage expenses when I'm retired, and I'll have some equity, to draw from or pass along to my kids at the end. But it wasn't this like get rich ticket that it's been for the past 25 years now or so.
And you didn't have house flipping shows and house reno shows and all this on television either, right? Because there was no interest. There was no interest in it.
there was an interest and the economics weren't there.
Yeah.
And maybe you're right. Now, I would love it, Lance, if that solution is elegant and efficient. I am concerned that there are certain cases where, we have antitrust regulation for a reason, right? Because there's times where some players get way too much advantage and they start wielding that unfairly, and eventually they need to be broken up, or that person's just going to own, that entity's just going to own its space, right?
That's fine. When you break up Google, we can talk about antitrust.
Yeah, I know. Well, that's our rant for coming up, because I'm going to lead the pack right there, right?
Look, the bottom line though is if you take away the financial incentive for hedge funds to own real estate, they'll stop doing it. Their whole MO is to make money for clients, and they have to generate a rate of return higher than another asset. So if the market's up 7, why would I invest in a real estate fund yielding 3?
Right. Well, and look, again, the spirit of my point was, I'd like to see the government take action on this, and the action that it might take, to your point, is getting out of the housing market and quit creating the distortions that's making this possible, right? Yeah. So, all right, yeah. So, who knows what's going to happen? I guess let me conclude the thought on this, which is, what likelihood do you give on us making progress on this versus you and I were having this conversation in 10 years, and at this point, the majority of housing stock is owned by the Blackstones of the world?
Well, let me get my crazy 8-ball over here real quick.
Okay, yeah.
Odds aren't good.
Odds aren't good. Okay, great. So let me ask this question, and I'll just get your high-level thoughts for this time. We can dig into it more later if you like. Does that place a premium on home ownership then in real estate? Like, look, if that's the trajectory of the next decade or two plus, do you want to get in to the extent that in 20 years you're one of the few families that still actually owns its own house?
Yeah, and no, look, there's an old saying, is like, they're not making more land, right? And right. Look, Bill Gates is now one of the largest farmland owners in the country. I don't know if you've been keeping up with the articles, but there was a whole big hubbub about him buying another huge chunk of land, I think in Wyoming or somewhere like this. But he's buying just huge chunks of farmland, and then he's renting it out to the farmers to farm it.
Right.
And so again, we're going to that place where, the rich have all the assets and everybody else is, basically leasing from them. And we're seeing that. And look, this isn't capitalism right now. We're talking about corporatism, and we're talking about other issues.
It's neo-feudalism to a certain extent.
And we're getting there, right? But we've allowed this because, none of this existed prior to prior to 2000. We didn't have this going on pre-2000. Actually, I'd suggest we didn't even have this going on pre-2008. Post-2008, because of all this liquidity, because of zero interest rates, because of Fed interventions, because of, choices that we make politically, we've opened up this whole can of worms that, and again, we've talked about the evils of corporate stock buybacks, which is fueling a lot of this. I told you about being in Italy. I'll look out over my balcony, and there's not just 1 or 2 yachts in the harbor. There's 30, 40 yachts, and we're not talking about, right. 30-foot boats.
You're talking mega yachts, yeah.
Yeah, and with helicopter pads on the back, and the whole 9 yards. And that's just the amount of money that's circulating in the economy is just mind-boggling. And we talk about this, but these are all the choices that we have made that we thought were, that this is going to be okay, right? It's going to, help support markets and the economy. But what we're trying, then the whole point of this was try to avoid having a recession, avoid having a financial crisis. Oh no, we don't want people to lose their houses. That's just terrible. That's part of the economic, and it is terrible, right? But it's part of the economic cleansing. And if you don't allow the economy to cleanse, and we used to, right? We allowed these economic cycles to happen, and we went through them, and, we survived. We came out the other side, and the economy was growing much stronger than it is today. But you can trace it all the way back to 1980 when we started running, fiscal deficits and started making these decisions. economic growth rates went from rising to falling, inflationary pressures went from rising to falling, yields went from rising to falling. I mean, everything started running in reverse, and it didn't seem to matter for 20 years because everything was still okay. But now over the last 20 years, everybody's waking up and going, hey, something's not right here. Well, no kidding, right? But if you want to fix the problem, we didn't get here overnight, and we're not going to get out of it overnight. But at some point, we're going to have to allow the system to reset itself, and that'll create better economic, prosperity across the board.
Yeah, and that's the one bullet on Michael I forgot to mention to you is the reset, because he and I talked about that, and I asked him directly if he saw a way out of this, just looking down the road, that didn't require a reset of the system and potentially even our monetary system. And his general answer was no. I think we are on track for that.
Well, no, we will. And look, I don't think it'll be in my lifetime. I don't think it'll be in his lifetime. Unfortunately, I think the Gen Zers are going to inherit the end game of all this. It takes time. Look, we talked about Japan numerous times, right? It's taken decades for them to get to where they are now, but they may be kind of at that crisis moment to where they're going to have to start going through an economic reevaluation of how they manage their economy. We're not there yet. I think, we could have another 10, 20, 30 years of this kind of trend that we're on, because nobody's willing to admit it's a problem. And again, the Fed's going to turn around as soon as there's a financial issue of whatsoever. They're going to turn around and start bailing out the markets. And now that the government has a taste of MMT, as soon as there's a problem, Nancy Pelosi and AOC and everybody else will be the first ones jumping up and down, send checks to households.
Right,
and everybody's going to, and all the voters are going to go, yay, checks to households. And, that's how they're going to get votes. And so, because nobody's equated, and it's very fascinating to me that nobody, and I talk to people all the time, they're like, man, inflation sucks, damn Biden, it's all his fault, oil prices. And it's like, no, dude, it's all that free money you got. Don't you realize that?
Yeah.
And they don't know that, right? They have no idea that free money is now causing this problem.
Well, and we've ranted about this a lot, and this is the nefarious part of how poorly our education system educates people about financial literacy, even how money's created, right? And so what happens is understandably, the ill-educated public demands more of what caused the problem, yeah. Right? And you understand, people are having trouble, putting food on the table, whatever. Yeah, please, I'll vote for the guy who's going to give me money right now. But that money just makes all the inflation worse in the future, yeah. Right? They just you're
look,
correct.
Look, we got a whole population right now that can't agree on the definition of gender, much less understand how monetary policy works. So
I know.
I don't really see a solution coming anytime soon.
Yeah, well, we talked about how two ways to sort of avoid an issue or deal with an issue. One is to see it coming and change your behavior beforehand. Yeah. The other is you hit it, ow, that's painful. Now I need to change my behavior. I think we've agreed, sadly, that that's how we as a nation are going to change here by that latter route. Okay. Great conversation. Got to wrap it up here, Lance. I want to end on a positive note.
Yes.
You and I have talked in bits over the past couple of videos about health. And we've talked about, a number of different aspects that we thought had been useful, and people have actually really responded well to that. I had interviewed a functional health expert, probably about 2 years ago or so, and just dragged up the video for that. And it's a really good sort of 20-minute overview of the key elements of functional health with some really good, just sort of like practical ways to start on each one of them. And I'm talking functional fitness, I'm talking nutrition, I'm talking sleep hygiene, I'm talking stress management. So if you want to go watch that video, just go to wealthion.com/health, and you can watch that. It's all free. All right. In this video, I think I lost track of how many times I sort of hammered home the point. Given this environment, you highly should be working with a good financial advisor. If you don't have a good one, or you'd like a second opinion by one that really gets all this, these macro trends that Lance and I have been talking about, feel free to schedule a free consultation with one of the financial advisors that Wealthion endorses, maybe even Lance and his firm itself. To do that, just go to wealthion.com and we'll connect you with one of them. Process only takes a couple of seconds. Again, it's free. There's no commitment to work with these guys. They just do it as a public service. And if you enjoy these weekly market recaps, I was counting them, Lance, and I've lost track of counting, but I think we're over 25 already. So we've already done more than a year's worth of the half a year's worth of these weekly market recaps. And I've really been enjoying them. And I think the audience has too. But folks, if you have, please support us by hitting the like button and then clicking on the red subscribe button below if you haven't already, as well as that little bell icon right next to it. And if you do like these things, let us know in the comment section below. And of course, we're always looking for ideas on how to make this even better. Lance, thanks so much for giving us so much of your time, especially digging out from your vacation and getting ready for your big move. Whatever happens in the markets, we'll track it together here next week. Thanks so much, buddy. Everybody else, thanks so much for watching.